We are watching market reaction to the latest round of economic data. As you just heard, personal income coming in up 0.4 and personal spending up 0.2%. And the core PCE rate, which the Federal Reserve watches closely, was up 1.6% again, in line with expectations. Joining me right now is Rieder. He is BlackRock's Global Chief Investment Officer of Fixed Income with $1.7 trillion in assets under management. Great to see you, Rick.
Good to be here.
Thanks you so much for joining us. So we just had some economic data. Do you watch the PCE? I mean, how focused are you on that in terms of what it tells us about inflation?
Very, very importantly. In fact, as you described on there, the Fed is that's the Fed's #1 metric. And one of the things that I think people don't recognize enough, the Fed's not really that far behind the curve. We're talking about 1.6%.
Yeah,
the Fed's target is 2. So the Fed's in no race. Core CPI is about 1.8. So we watch core PCE very, very closely. If you start, which we think will happen this year, it'll accelerate over 2. But you think about it, you put that in historic context, it's not that scary a number. So the Fed's going to keep moving, but they're in no race, and they're in no rush to do it.
So let's talk about that, because yesterday I was really surprised to see this new speculation that the Fed might raise rates 5 times this year. Is that what you think?
No. No. So, I mean, part of this number is suggestive of it. The Fed's going to keep going. You know, they're going to move in the dots. There is some ambiguity around, do they go 3 times, 4 times? You know, I think one of the things that the markets are focused on is not necessarily the speed, it's where is the ultimate destination they're going and how restrictive are they going to be. And one of the things that markets got nervous about is they'll keep moving on a steady pace. They don't need to pick up the pace. They don't need to go 5 times to pick up the pace, but it's what is the destination, and that's one of the things that the markets are focused on, but they don't need to race.
Well, this is what, I mean, there's been so much upset about higher rates, about the possibility of inflation. Has this been all overdone? You like equities here, don't you?
I do. I think they will ultimately go higher. There's something, I don't know if I have that chart that we can show.
Yeah, let's bring up Rick's chart.
There's something that's really powerful today, and what people I don't think consider enough is in the last 5 years, we've been in this environment where we've been at 0 interest rates. The funds rate is sat at 0. The front end of the yield curve, so 2-year Treasury has been at 0. So where do you go to get your yield? You've had to go. I mean, this chart is extraordinary. You take, by the way, if you look at this chart versus history, and you go back to 06, 07, if you can see the blue line, you think about what's happening, you can now buy the front end of the yield curve cheaper than the dividend payout. You look at, I mean, it's pretty ominous when you look at 06, 07. By the way, I don't think we're in an ominous period today. But the alternative for equities, the alternative for how or credit risk, for how you take bonds, high yield bonds, et cetera, all of a sudden you could buy the front end of the yield curve. And if you don't think the Fed is going to run faster, it's incredibly attractive today. When we finish the year, I don't think rates are moving that much higher. But I do think you can move up the 10-year and go to 3.25, 3.5. But that front end of the yield curve is all of a sudden an alternative investment to other things that I carry really well. If I'm an individual investor, I can just buy 2-year Treasuries and for the first time in 5 years actually get above the rate of inflation, which is terrific. Above
the rate of inflation, but not out of this world high rates. You're still talking about relatively low rates.
Totally.
Yeah.
Totally. But and the point being, and people focus on the 10-year Treasury and they say if we did 3% 10-year, my God, it's all over. The 3-year, you know, the 10-year Treasury we think could probably go to 3.25 this year. But we think it'll be more in the second half of the year. But it's not that scary. We're not talking about historically high rates.
Well, I mean, 2.76% is where we are right now. And any time we get close to 3%, this market sells off.
Yeah, I don't really understand. It's like 2.95 is okay, but don't hit 3.
Right.
I don't really understand that. I mean, there is a difference. By the way, the front end of the yield curve is a big difference because it means that now I don't have to take any risk. I don't have to take 10-year Treasury risk. That is a big deal. But listen, if rates move up gradually, then markets will be fine.
So you think there are values in equities right now?
I do.
Tell us about that.
So I think what ends up happening is, you know, people, whether it's tech or tariffs, there is the short-term data that I think spooks people in terms of how much risk, and people have taken a lot of risk. In January, people were building a lot of risk, but valuations in the equity market today are not that bad. I mean, there are places I would argue that, you know, I'm not in the run fixed income, but when you think about, you know, some of where the financials are and some of the multiples on some of these, they're actually pretty attractive today. You know, so some complement of I could buy Treasuries in the front end, carry well. And then there's parts of the equity market and I can take some risk and you can build a balanced portfolio.
Especially going into the reporting season, which we're about to enter, the first quarter reporting season, where we're expecting corporate earnings to be up 16.5% for the first quarter.
Not only earnings, I mean, we look a lot at revenues to get a sense for what is the forward growth. The revenues are going to be pretty substantial, meaning you're going to have what we think will be durable earnings. And I'm a big believer this tax bill, which people don't talk about enough. The ability to write off your direct expensing and the fact that it's sunsetted companies, you're seeing CapEx surge. It means growth will continue to be good, earnings will continue to be good. And by the way, a 21% tax rate means that these numbers are going to look pretty positive.
Oh,
for a
yeah.
while.
I mean, going from a corporate rate of 40%, close to 40% to 21% is a huge deal. And you think this is going to have legs. It's not just going to be an overnight success, but we're going to see an impact to corporates for a year or two.
Yeah, I mean, yes. I mean, I think people underestimate the cash flow benefit for companies, particularly financials, particularly healthcare, managed care, et cetera. The flow through because of CapEx, writing off interest, writing off CapEx is a big deal, and it will spur spending. Now, that being said, there's one thing that I do think is a concern. The amount of debt we're putting in the system is a lot.
Yeah, and the Treasury is going to have to borrow $1 trillion this fiscal year to cover government spending, lower tax revenue. How does that impact the bond market?
It's a big deal. By the way, it'll impact the bond market and then ultimately like the equity market. You know, listen, there is, and part of what's driven short-term rates is we're pumping so many Treasury bills. We're going to do bills. We're going to do 2 years, 3 years, 5 years. It's a lot of debt. For the next 3 years, $1 trillion of additional net debt that has to be funded by the marketplace. It's a lot. It's what will push, you know, inflation is not scary. It's what's going to push rates moderately higher. You know, what will be key is to watch how we're going to absorb that. There's ways to make money in fixed income. You've got to be really careful with how much interest rate exposure you have with this much issuance that's got to come to the market.
So how do you make money in fixed income right now?
So first of all, I mean, you know, holding the front end of the yield curve
holding the front, you said it earlier.
So then emerging markets are, you know, people have been blown away. Like, why with all this volatility, emerging markets aren't moving around that much.
Yeah.
It's because they don't have the leverage they used to have, and they're giving you substantial yield. So we like owning that. We like buying a lot of secured assets. So commercial mortgages, non-agencies, carry really well. Don't take a lot of yield curve risk. Is really attractive. You can make money in fixed income.
Let me get your take on the LIBOR. The Journal today is reporting that the rates rapid rise.
Yeah.
They're highlighting that. What do you think of the implications of that?
It's huge. I mean, it is today. It is the financing of the marketplace. Some of it has to do with the repatriation. That's a short-term impact. Some of it has to do with the amount of Treasury bill issuance that's getting done. And then there's also financing of some of the foreign banks because of the tax bill, some impacts of that. It's incredibly important because it's the gearing of how the financial system works. It doesn't get focused on enough. Our sense is it'll start to stabilize here. We don't think it's going to come back a lot, but it'll stabilize. And a lot of the pressures from the bill issuance, a lot of the pressures from the repatriation will start to stabilize. But people underestimate how big a deal that is.
Wow.
That is so much more important than virtually anything else because it's the gearing of the financial system.
Rick, thanks so much for your insights.
My pleasure.
Great to see you. I'll see you on Wall Street this weekend. Rick Rieder, BlackRock.